Thank you, Gareth. Good afternoon, everyone, and welcome again to our webinar on UK inflation. I would like to first introduce our presenters for today. We are joined by Theo Hapsalis, Head of UK Rate Strategy at NatWest Markets, Paul Zeo from our Inflation Trading Desk, Helen Lees from our NTN Syndicate team, and last but definitely not least, we are delighted to be joined by Nick Corker, Assistant Treasurer at Severn Trent. The aim of today's session is to share the recent developments in the UK inflation market and our views on where we go from here. We will also discuss recent trends and activity that we have seen from corporates and sponsors across both inflation derivatives and inflation bond markets. Helen will then discuss some of the considerations around inflation-linked issuance, and following that, there will be a spotlight on Severn Trent's CPIH-linked bond, where Nick will be sharing his insights. As a reminder, there is Q&A available. You can submit your questions throughout the course of the presentation via the Q&A button. We are very keen to take your questions, and we will try to answer them all at the end. So without any further delay, I will now hand over to Theo to kick off the session.
Thank you very much, Mariana. Welcome, everyone. So I will present on the inflation market. I will talk about the outlook, and we'll have a specific emphasis on the UK. So let's start with the first slide. So the first slide shows really what is going on in global inflation markets. What we can see is that obviously there is a global element to inflation. So the three series that you see, the one in red, this is UK RPI, the one in light blue, that is US CPI, the year-on-year rate, and in purple, you see the Euro index. What you see is that there are periods of time when, with a synchronous increase, like in 2007, 2008, obviously what happened in 2008 and 2009 had an impact across all indices, and you can see the sharp collapse, and then you can see also quite a significant rebound, especially in the UK. When you look at the 2010, 2012 period, you see that UK RPI stood and exceeded the other indices. My point from that is that you have a common element, but to some extent also indices can diverge. Now, moving to the later years, what you do see is something very interesting. What happened around 2016 and 2017, you see the red line being above the other two lines, UK RPI being higher, and this was a Brexit effect. And what you see now in late 2020 and 2021 now is really all those three shooting up high. Because this is very much a commodity-led inflation move and inflation increase, this is why it is much more evident in the US. This is why you see that the light blue line actually is rising at a faster pace, then followed by the UK, and then by the Euro area, where you've got simply a lot less inflation, and inflation is a lot less volatile. Let's move to the next slide, please. The next slide really shows what has happened in the US inflation market. The US inflation market has been very important because of the interplay and the impact that it had across other markets. This is why we'll discuss it actually first. So what you see is that if we go back to, say, 1 year ago, when you look at the purple line, and these lines shows really 1 year inflation expectations at different forward times in the future. So basically, what do market participants think that 1 year inflation will be in, say, 5 years time, or 10 years time, or 30 years time? And what you see is that the whole term structure was low. So pretty much the market did expect low inflation for much longer. And in fact, when you look to the bottom left of the chart, you see some numbers that were close to 1.1%. What you do see, so this 5% that is realizing now, it was priced at 1.1, by the way. So to put things into context, what you see now is that we had a move up, and the move up is in the light blue line, and you can see that that light blue line has moved up across all term structures. So basically, this is a story of fiscal spending coming into the picture, and that we're out of that deflationary spiral. So the majority of the move happened by the end of 2020. What you also see now, when we look at the most recent term structure, which is as of 18th of June, well, there is actually a lot of demand, a lot of support for higher short-term inflation. So right now, the market thinks that inflation will be higher. It's not that it will become higher at some point in the future. That point in time is now. So let's move to the next slide. And the next slide really describes the last 6 weeks, which I think are very important because you all have heard what has happened with the Fed, but also you've heard probably what has been going on with commodities. And if we go back to the 12th of May, that was roughly the peak of inflation fear. Now, it is the same chart as before, but I showed just 2 timestamps. And it is really interesting to see that those show dated forward, this 1 year inflation in 1 year's time, and 1 year inflation in 2 years time, et cetera, at some point, they were substantially higher. We talk about 50 basis points higher. So there is not much discussion about it, but I think that this is significant, that the market has gone through a shift from inflation fear and inflation paranoia to just an inflation concern. So if we were in May, everybody would be terrified of crazy higher inflation, but this has to a large extent changed. Let's move on to the next slide. This takes things to the UK, and fine, we did have obviously all those moves in the US, but what's going on in the UK? And a good way to look at it is really to look at the composition. Where is inflation coming from, right? So to do that, and this one is actually a bit of a complicated slide, so I'll try to describe it as easily as I can. But we look at different categories of the RPI basket. We start with food, then catering, then alcoholic beverages, et cetera, et cetera. And what you see is a month-on-month increase from 2020 and onwards. How did that compare to a typical month-on-month increase for that specific month? So we compare the month-on-month increases since 2020 relative to the average month-on-month increases that you had in the past. What you see is that as we go towards the most recent points, so the April print and the May print, you see that there are a lot more green than red. So the green means that we've got the inflation overshoot. What you see is that in food, for example, where we had several months of inflation overshoot, that is becoming, that is reversing. What you also see is that in catering, well, in August, we had a minus 10% move. So this was the Eat Out to Help Out scheme. And then that obviously normalized in September. But we do have a lot of technicalities. When we look at other parts, fuels and lighting, this is really what's going on in, with off-gem prices and clothing and footwear. They have also been a bit stronger recently, together with other parts of the basket, in particular leisure goods. Now, if we think about it, we do have a reversal of the disinflationary environment, and we do have some strength. So this is indisputable. However, we do agree with what was discussed by the BOE a few hours ago, that this inflation rise is transitory, because even in parts where we were afraid of really substantially higher inflation, for example, housing is a part where we did have from pretty much September 2020 to April, we did have a lot of upside surprises. Well, the market has pretty much stabilized now. So it has stabilized, and in fact, actually, we did have a fall in May in housing, in house prices, relative to what it was a typical house price increase during May. So long story short, yes, inflation will be higher, but we think that this will be transitory. And the question is how transitory and where is the peak? Let's move to the next slide, please. The next slide shows our UK inflation forecast. These are the NatWest market inflation forecast. And before I discuss it, there is a detailed piece that was published by Ross Walker, and he has done the work on that specific part. So I'm showing actually his numbers. And what you do see here is that there is a difference between the market implied numbers and our numbers. What you see is that the market prices in a lot more, first of all, a higher term structure, and particularly in 2021. In 2022 and onwards, the two series roughly converge. So do we talk about RPI heading towards 4.2, 4.4%? Yes, but we think that the peak will be there at around 4.4, not around 4.7, and then at some point it was even close to 5%. So yes, we do expect the inflation numbers to be high, but we do definitely have a profile which is below what the market is pricing in. Let's move to the next slide, please. What you see here is 20-year real yields and 20-year nominal yields. And usually the two are very well correlated. We talk about a beta between 0.65. So really a 10 basis point move in conventional yields or nominal yields translates into a 6.5 basis point move in real yields. What you do see, however, is that I would say since December and onwards, conventional yields have moved up. Real yields at the beginning followed that sell-off, but in very recent months, so when we talk about the last 3 months, what you see is that conventional yields have stayed high, whereas real yields have actually fallen. This has led to wider break-evens. So this is quite significant, and it shows that even though the conventional yield may be the same, the composition is different, with a break-even being a bigger part of its composition and the real yield actually being quite lower. Next slide, please. This is the slide that gives us the theme of why, if I was an issuer, if I could issue debt, I think that it's a fantastic time to issue inflation-linked debt right now. It is a slide that I've shown to the DMO. I've discussed it with the DMO, and it is a slide that I've used in our presentation when it came to talking about specific sectors to issue debt. What you see is a term structure in light blue, which is if we were, to ignore the reform, if we thought that the reform doesn't happen. And the line in purple is the one that the market prices in. Now, if there was no reform, you would have to price in an 80 basis point of a premium to RPI because, well, it would be a higher index. The reform RPI, we know that will be printing lower. So what you see is that the forwards from roughly the 90 years and onwards, they diverge. Now, the point that I want to make is that in many cases, those forwards are trading well above 4%. And this is significant. These are levels that we have not seen in the past. So it is about having very high expectations of short-term inflation that have created demand for inflation-linked assets, that they've pushed all break-evens high. And because of that scarcity, of the relative scarcity of inflation-linked paper, all inflation expectations are up in the sky. This creates an opportunity to issue. For example, if you want to issue around the 20-year bucket, you can see I've put a point for the IL39, and you can see that this is a part of the curve where we have a hump, and the DMO, they were aware of that, and this is why they issued at that part of the curve. There were some discussions to issue a 45, a link of the maturing in 2045, but we told the DMO, don't do it. It's pretty much not a great point. It's a cheap point, and the same holds also for 30-year bonds. So if someone was to issue, you have got very expensive valuations around that 15-year point, which actually makes issuance in that sector highly attractive. Now, let's move on to the next slide. And this shows really what's going on between RPI and CPI. So, and this is the difference between the two in terms of the wedge. What you see is really that, there is a term structure, and you see that the wedge, which starts around 65 basis points, you can see that this narrows substantially. You can see it even trade around 25 basis points quite later. Now, this is in the spot swaps, okay? But the reform happens after 2020. So let's go to the next slide, which is a better way to discuss this. And the next slide, this slide is better because we don't do some sort of averaging with reform or without reform. We just compare likes for like. So when we look at this chart, for example, we look at the 4-year, 1-year forward, we've got a level of around 70 basis points, which tells us that the market prices in a CPI RPI wedge around 70 basis points. That's fine. If in reality, the difference is around 80 basis points or 90, you can price at 20 basis points for the scarcity of CPI paper. That's fine. What you see also later is that this wedge is compressing. So when you look at, for example, the 80-year 1-year point, you see that this is 40 basis points, and it falls to as much as 10 basis points. So the notion that the RPI reform is not priced in is not accurate. The RPI reform is priced in, but we think that in several parts of the curve is not sufficiently priced in because the market does think that all those legal challenges may lead to some change, in the decision that was taken on the 25th of November last year. 2 more slides, and then I will pass it on to Paul. So let's go to the next slide, please, which is on issuance. Issuance, I will be very brief. Big bubbles means a lot of DV01 being issued. High level means that the bubble and that significant DV01 comes from long-dated bonds. What you see is that those bubbles have been going from 2015 up to 2020 lower and smaller. So we get less duration, so less DV1 being issued, and from shorter bonds. This was something deliberate because in 2017, pretty much the DMO and the OBR, they realized that the UK had too much inflation in debt. But now, with COVID, the amount and the composition of debt did change. And what we think is that now linked debt will be issued more. And again, why that? Let's move to the next slide. What you see here is some bubbles that may look small for the past, but then you see that around 2020-21, those bubbles are getting quite big. Well, if we left the same size of bubbles, the 2020-21 would pretty much cover the whole picture. So we had to shrink the other bubbles to make it comparable. What you do see here is that the supply that we got in 2021 was so much higher that it shrinks everything else. And in relative terms, it creates a reset. So now we don't have much linked supply. And because of that, the DMO is aware and they are happy to issue more long dated and higher, a higher amount of link issuance. This is an ongoing process. In the previous year, we had only 8% of debt being index linked. Back pre-2017, we talk about 25-ish% of issuance. So 25 versus 8 is a big difference. And this year we have 12%. We think that this number will go towards 15%. So we think that this number will continue to increase. Bottom line, right now, inflation expectations are very high, and it is an opportune moment if someone is looking at issuing, simply because right now the DMO has still not started issuing a lot of linkage. Once the DMO starts to issue a lot more linkage, then there will be more competition for everyone, and we do expect all linker, all break-even valuations to contract. And at this point, I would like to pass it on to my colleague, Paul Zeo, to give you an outlook of the trading market.
Hi, everyone, and thank you, Theo, for the good summary. So I'll try to give you a summary of what we saw on the trading side over the past few months and the past few weeks. Obviously, it's been fairly busy in inflation with some pretty big moves in the inflation market. First, we had obviously the COVID crisis, which brought down all the inflation expectations, and this was followed by the ongoing reopening of the economy, which has kind of brought up all the inflation expectations and all the inflation markets across the globe, starting with the US back in January, and now we've got the same moves in the UK and in Europe. So the market is quite optimistic about the future path of inflation. We are forecasting, the market is forecasting roughly 4% of CPI inflation by the end of 2021 and close to 3.25% by early 2022. That's CPI inflation. Inflation expectations further out the curve, so like your 10-year inflation expectation, which is your inflation expectations over a 10-year horizon, are also very optimistic. The market is trading around 3 to 3.1% in CPI, so we are roughly 1% above the Bank of England target in this thing. So it's quite optimistic, and it raises some question about like whether the market thinks that the BOE is going to be able to do something to tackle the inflation, but it's also a story about what's the current drivers of the inflation market, where are we seeing the demand, and what kind of supply do we see in the market. So the main drivers we think at the moment are obviously all the inflation data we get on a monthly basis, so the third Wednesday of every single month. This is the major focus every month for the inflation market. The volatility and all the interest is very much around those data because they are going to be like the main drivers of the rest of the market. Like people want to know where inflation is going to realize to be able to clearly trade it and take a view further out the curve. The second main driver is obviously going to be the central bank and what they do to tackle this inflation, as in when do we expect them to first hike rates. This is going to be like one of the main drivers for sure, because the earlier they're going to hike rate, the lower your inflation is going to be by like the standard like mechanism, and the rest is obviously like the issuance of inflation-linked bond by the debt management office to obviously finance the recovery and finance the economy versus the demand we are seeing for inflation bonds from pension funds. As Theo was saying, there has been a pretty big dislocations over the past few months between the supply, so the issuance of inflation-linked debt from the government, and the demand. The supply has been very well swallowed by the demand, and we've seen quite a huge demand from all the pension funds as a result of just liability hedging. So because they are repaying, obviously, some inflation-linked liabilities, they need to buy some inflation in the market, as in they need to pay fixed and receive RPI or CPI in the market, and this has had a pretty big impact on the market. So this pushed up inflation across the curve, which is why, for example, your 10-year rate of inflation is now trading quite far from the Bank of England forecast. It's the same thing if you look at an inflation measure such as your 10-year rate in 10-year time, which is your inflation rate between 2031 and 2041. If you look at this rate is actually CPI because of the RPI reform. So after 2030, RPI is going to move to CPI, so the two are going to be the same. So your rate of inflation between 2031 and 2041 is a CPI rate, and this rate is trading as high as 3.5% in the market. So that's 1.5% higher than the Bank of England target. Why is it trading there? I think it's just a mismatch between the supply and the demand. The demand has been so huge over the past few months with the rally in equities, like freeing up a lot of cash, and meaning all the pension funds were able to buy some bonds to hedge more and more their liabilities, and this had the impact of pushing higher all the inflation expectations. The last driver of the market, and I think the most interesting one for this call, is the activity coming from the CPI risk management from utility clients and infrastructure projects. It's a theme that is definitely picking up, and we're seeing more and more interest from our client base, our corporate client base, but also our institutional client base to look at some CPI trades. So we had like a notable pickup in risk management activity from utility clients. These clients have a regulated asset base and revenues which are linked to the CPIH index. So as a result, they need to hedge their CPIH revenues by paying this rate in the market and receiving in exchange of that a fixed rate. So we think that at the moment it's pretty good timing to do that, especially if you consider that your 10-year rate, the one I was talking about earlier, is trading 1.5% above the Bank of England target. I think it's quite an appealing level to lock for most clients, because I think that if you were to hold this trade for a 20-year period, you would probably lock in like 100 basis points, which is 1% of profit on the trade, if you believe that the Bank of England is able to keep the inflation around the inflation targets, which is 2%. So we've seen quite a lot of activity from these utility clients, and they have been pretty proactive in converting some of their existing nominal bonds into CPI-linked bonds, synthetically, using bond-style inflation swaps. For example, we recently won the mandate of the execution of a CPI trade, which was approximately 500,000 pounds of DV on1 risk in the market. So this trade was pretty huge, and the way we executed it, so we approached the client to show him the pretty appealing levels in this inflation curve. We then underwrote the wedge level, which is the difference in rate between the CPI and the RPI, and post-execution, we hedged the risk via our institutional clients, so no impact on the market, very smooth execution, and for the rest of the risk, the inflation risk, we hedged it throughout the day and in the next few days, and in the past few days with same thing, our institutional clients and some pension funds who were keen to buy some inflation. So a pretty decent trade, and we've seen more and more of those deals in the market over the past few weeks. I would say we've seen more or less one deal a week, approximately the same size. So this market is clearly picking up, and the levels in the long end forwards of the RPI curve, as in the one I was mentioning earlier, are so attractive that people are starting to jump in to lock in these amazing levels. We have also seen some activity from the project finance and infrastructure sponsors, and I think it's probably the same thing. Given the move higher in inflation break-even, we've seen interest from those type of investors to lock in these amazing rates, and especially because we're just trading 1.5% higher than the Bank of England target. So it's quite a strong argument, and I find it quite appealing for an institutional investor who is looking to hedge some CPI-linked revenues. So I think that's all from my side. I'd be happy to take any question if you have any, and I will now hand over to Helen to discuss the corporate inflation-linked issuance. Thank you very much.
Thanks very much. So yes, I'm going to talk about inflation-linked corporate bonds. So what drives the demand here? The recent trends we've seen. Look at some of the pricing components that goes into pricing an RPI or a CPI-linked bond, and then we'll do a spotlight on a landmark transaction that was printed by Severn Trent Water in December, in which we're an active book runner. And as Mariana said at the beginning, we're going to be joined by Nick Corker, who is the Assistant Treasurer at Severn Trent Water. So first of all, next slide, please. So what is driving the demand for corporate inflation-linked bonds? Well, as Theo and Paul touched on there, it's coming from two main pockets, which is insurance and pension funds. So on the pension side, they have the CPI and RPI linked liabilities, and therefore want to hold assets that match these liabilities in order to hedge their funding risk. On the insurer side, it's those that operate in the BPA market, or bulk purchase annuity market, which is essentially when companies who are looking to offload their defined benefit pension schemes and the associated risks can go into different types of buy-ins and buyouts with the insurers, but essentially they're transferring the liabilities onto the insurers for a price. And the size of this BPA market can be really quite significant. It was a bumpy year in 2019, and we saw about over 40 billion of transactions that went through. This year and post-COVID, it's been a bit lower, expecting around 25 to 35 billion. And of this, around 5 billion of these liabilities are CPI linked. So really quite sizable amounts of liabilities that need to be hedged there by the insurers. Now, under Solvency II, they're incentivized to match the cash flows of their liabilities with the assets they hold in order to get what's called the matching adjustment, and that enables them to hold a lower level of capital. So in this reason, they're incentivized to hold RPI or CPI linked assets. And as Theo and Paul have been talking about, you obviously have the RPI linked gilt market, which is where they can buy RPI assets. Clearly, there's still demand for corporate RPI assets, given that there will be a high rate of return. But as there has to date been no CPI linked gilts, there is a significant lack of supply for these assets, and they've been much harder to hedge. The only options being the swap market or the corporate CPI linked market. Now, tenor-wise, given that it's pension and insurers that are the main buyer base, it's typically the longer maturities where we see the most demand, so 10 years and out. For insurance, it tends to be between 15 and 25 years. For the pension funds, they can go even longer, say from 20 out to 35 years, but it's really the longer maturities, given that it's pension funds and insurers that are buying. And what we've seen in the dynamic between these two essentially competing buyer bases, historically, the life insurers were the main buyer base of RPI and CPI assets. This has changed over the last few years, and we are seeing the pension funds become more competitive, particularly when you're talking about slightly lower rated investment grade names, as they do not have to hold high levels of capital under Solvency II for lower rated assets. So they can be a bit more competitive. Next slide, please, Gareth. So that was the demand side. Now, on the supply side, as I think we've been alluding to and mentioning on this call, there is a significant lack of supply. The transactions that you can hopefully see on your screen are those publicly announced corporate inflation-linked bonds that have been printed going back to 2015. And the fact they fit on one slide, I think, tells you what lack of supply there is. Particularly this year, we do expect it to pick up a little bit towards the end of the year, but not significantly. You can see the main issuers have been utilities based on the regulatory regimes and the fact that revenues and asset bases are linked to inflation, and particularly the water sector have been quite active. United Utilities, one of the main issuers and one of the early movers for CPI linked issuance. And as I mentioned earlier, Severn Trent being one of the largest issuers from last year and the first to print a CPIH-linked bond. But as you can see, there is a significant supply-demand imbalance, particularly for CPI, where you haven't had the government issuance so far, and there's been very little supply in the corporate market. Next slide, please. So now just to look at the pricing build out. So how would go about pricing an RPI or CPI linked bond and the components that go into that. So for an RPI linked bond, it's relatively straightforward. You're starting off with your RPI linked gilt, which is where the coupon payments and principal repayments would be adjusted in line with movements in RPI. You're adding your conventional credit spread, which if you have outstanding bonds is relatively easy to ascertain. If you don't have an outstanding curve, then it'll be a case of looking at comparable peers. And then adding the linker spread, which is essentially compensating investors for holding a less liquid security. Historically, we've seen this level around 15 to 20 basis points. There's obviously not been very many recent data points we can point to, and reverses come in from investors anything from 0 to 5 up to 30, 35. But historically, the average has been around 15 to 20 basis points for this linker premium. For a CPI linked bond, you're starting with the same components, given there's been no CPI linked gilts, you're pricing over an RPI linked gilt, again adding the conventional secondary spread, and then adding the wedge, which is the difference between future expectations of RPI and CPI inflation measures. And given that CPI is almost always lower than RPI, it's essentially compensating for the fact that you're pricing a CPI linked security over an RPI linked gilt. You don't tend to include the linker premium again. Some investors do break it out when they're talking about the wedge, but most are referring to the spread versus conventional secondaries. And you would look at a new issue concession, but given the lack of supply, it is typically very low or zero. Now, this will highly likely bring you to a yield which is negative, given where linkers are trading and where credit spreads are, which means you price the bond with a very low coupon, say 1 basis point, and above par proceeds. So you'll be receiving in more proceeds than your normal amount of the bond. You would have a very low coupon, so it's favorable for ICR metrics. But obviously another consideration is the fact that you have the balloon payment at maturity, given that the principal repayment is adjusted by CPI or RPI over the life of the bond. Next slide, please. So for a CPI linked MTN, given the components that go into pricing that, and given that ascertaining your conventional secondary spread is relatively straightforward, when you're talking to investors, generally discussions come down to what is their view of the wedge. And as we said, that's the difference between future expectations of RPI and CPI, and it's relatively straightforward in the swap market. When you're talking about investors buying a bond, a cash asset, there are various other components that are going into that. So yes, they'll be looking at the swap market, that they can look at broker screens and see where things are generally trading. But for pension and insurers, it will also come down to their actuarial assumptions. So for a pension fund, for example, that's going through their 3-year cycle, it will depend where they're at, how recently it's been updated, are they working off prehistorical averages? For insurance companies, it's, as I mentioned earlier, they will be affected by the rating of the issuer because of the capital they have to hold against the assets. So they may quote a slightly wider wedge for a lower rated issuer versus a higher rated issuer. It will depend on things like the hedge ratio of the portfolio. So how hedged are they already in RPI or CPI? And it will also come down to a liquidity premium, given we're talking about sub-benchmark sizes and inflation-linked securities, which are less liquid. But again, given the supply-demand imbalance, this does mitigate any illiquidity premium. So given all these components that are going into investor views of the wedge, you can hopefully see why you might get different views from investors that you may think are similar types of investors. But what's the general trend that we've seen in the wedge pricing? Well, again, given these components are going into it, the bond wedge pricing tends to be wider than what you're seeing in the swap markets. However, we have seen the same narrowing in the wedge post the RPI reform consultation, which was announced in 2019 and concluded last year, even though, as we already mentioned, 3 major pension funds are contesting it, but it has caused a narrowing in the wedge. So for 20-year bond wedge ballpark, we were talking 80, 90 bits in mid-2019. This came down to around 60, 70 last year. Now, given the lack of supply, we don't have any data points for this year, but there would be an expectation it could come down inside this, again, given the lack of supply. So conclusion on the wedge, yes, we expect this narrowing to continue. The supply-demand imbalance is significantly in issuers' favour. So when you're executing a CPI linked bond, it's really about how do you maximize this benefit. One of the ways, and we've been involved with, is to conduct a bidding competition. which is a good way of getting maximum pricing tension. We'll talk a little bit more about this now. Next slide, please. When we look at the Severn Trent water transaction, which I say we printed with Severn Trent Water in December last year. So Severn Trent Water were looking to the MTN market to raise up to 100 million of funding, and they chose to print a CPI or a CPIH-linked bond rather than go down the printing convention and doing a synthetic swap overlay. They went out at the end of November, so just following the announcement of the conclusion of the RPI reform. They were quite keen on doing a public process. So rather than launching a full public bond as you would do in the public bond markets, we went down the route of putting high-level details on the website and essentially inviting investors to show in their interest. And we went out to about 10 to 12 investors, which is a reflection of the inflation-linked market, because yes, it is very deep, for all the reasons talked about earlier, but it's not a huge number of different investors. And it took just over a week from the initial putting the announcement out on the website to receiving interest in, refining that interest and selecting the winning bidder and pricing, with the end result being 100 million sterling, 35-year CPIH-linked MTN sold to a single investor, which came in the context of secondaries plus the bond wedge we were seeing at that time, as you would have expected, and plus a small CPIH basis. And it's a notable transaction, as we believe it was the first CPIH-linked bond to be printed. So that just gives this sort of high-level summary of the transaction. And now I'm very pleased to be joined by Nick Corker. So thanks very much, Nick, for joining us today. And maybe it would be helpful if, first of all, you wouldn't mind just giving a quick background on Severn Trent Water and explain what your objectives were when you set out to raise the debt.
Yeah, sure. Severn Trent Water, we're basically the regional water and sewage provider for about 4.6 million households in Midlands and Mid Wales. In terms of scale, our turnover is about 1.8 billion. We've got net debt of around 6.5 billion and a regulated asset base of around 10 billion. And we've got a pretty significant funding requirement over the next 4 or 5 years. That's to invest in our capital and ensure we can provide good water and wastewater to our customers. That's around 3 billion in total. So in terms of our funding, we look at raising that through sort of the core traditional markets we've used, which is sterling and USPP through benchmark size transactions. And then we're also looking at doing some smaller transactions, and that's where this transaction fitted in. And when I say smaller in our context, we mean kind of around 100 million or so, that kind of range. So there's a couple of real reasons in terms of objectives, I guess. In terms of size, 100 million works well for us. It allows us to manage our liquidity effectively, reducing cost of carry, provides us with diversification by looking at different pools of investors, and it ties in with our regulatory model where we are targeted in terms of new debt against the iBox, so smaller transactions allow us to average in the cost of our new debt. As well as looking at a small transaction, the other objective on this was to get some CPI or CPIH linkage into our debt mix. So our regulatory model is inflation based and has been CPIH based since 2020. And we have around 25% of our debt that's index linked, which provides us with a hedge against our assets and our revenue stream. And we were very keen to have this in a CPI or ideally a CPIH format to help us maintain our sort of 25% inflation mix. And also it seemed like a very good time to extend our inflation given where market expectations of inflation have been over the last year or so. So those are the main objectives.
Thanks, Nick. So can you just talk a bit now maybe about what other options you considered and why you went for inflation-linked debt versus the issuing conventional and doing a derivative overlay? Yeah, sure.
We looked at, there's two options really for us, I guess. So it was between going down the nominal route and adding in swaps or through the debt route. We have never done any inflation-linked swaps just historically within our business. And that's been quite positively seen by rating agencies and particularly USPP investors. I guess it's sort of more straightforward, more simple to not have them in, and it takes away some of the risks you might have around fair valuing long-dated derivatives and the fact you have accretion pay downs as you do with the derivatives. So there's an incentive in that way to go down the debt route. We also looked at the pricing at the time, and because we were looking at longer durations, we were looking at 15 or 20 years plus. when you took into account the swap costs, the debt route actually appeared to be cheaper at the time. So that was a real incentive to go down the debt route, and it also saved in terms of our credit lines. So whereas long-dated inflation-linked swaps obviously are quite credit intensive. So that was the main driver for going down the debt route.
Yeah, thank you. So now maybe let's talk a bit about the internal process you had to go through before issuing. How you went about getting the board approval. Was there any difficulties, anything in particular they focused on, given that it was issuing, you know, something essentially you hadn't really printed before? Was there anything in particular you had to get them comfortable on?
Yeah, sure. So we have a treasury committee internally, which monitors our treasury activities and allows us to be kind of nimble in terms of going to the market. They were most focused on how we were making sure this was a well-valued deal, basically. So we had to spend a bit of time working through the pricing and using kind of the same analysis you presented a minute ago, which sort of breaking down the debt into its constituent parts and how you come to the full pricing from that. We also used a debt advisor as part of the transaction, and that gave them a great deal of reassurance that, one, we were doing the right type of transaction, and two, it was achieving fair pricing. And I guess the method we used of going through a competitive process also helped, because it allowed us to show that we'd demonstrated the trade we'd done against other investors and achieved the best pricing we could.
Yeah, that leads on to the next question. So with the external process that we went through, how did you find the process of issuing a bond via an announcement on your website and engaging with several investors versus, I suppose, the more traditional reverse inquiry type route for an MTN of this size?
Yeah, I think that worked really well for us. We were keen to make sure it was a competitive process and that we could have good transparency around the pricing. So we were keen to go down that route. So how we went about it, I guess we provided yourselves with a term sheet in terms of the kind of how we wanted the transaction to look. So we looked at the size of the transaction. We wanted 50 million plus. We looked at the tenor, so looking at 15 years plus. We also said we wanted it to be either CPI or CPIH, with a preference towards the latter, albeit we didn't want to pay a great deal of premium for that. And then we also wanted to test the market around a number of other parameters. So it's things like looking at if we could do a delayed draw, which we've successfully done previously on USPP transactions. And we also wanted to look at caps and floors, whether that would be possible in this. So I think by going out to a wider pool of investors and looking kind of across the market at the 10 or 12 best investors that you'd identified was a good way we could test the appetite on all of those. So particularly allowed us to look at very fine pricing by looking across it and being flexible in terms of our tenors on that. So yeah, I think it works well for us.
Yeah, I agree. And I think it probably helped the way that you got to speak to investors over the course of the week, whittling down what was important to you in that way in terms of delayed draw, CPIH, etc. So hopefully, that worked well over the transaction.
And I think it became apparent as we went through the process that certain things will be less easy to achieve, such as the delayed draw and the caps and floors. And I think what we worked out as we went through was that there were things that were more important to us than others, and we really ended up, I guess, focusing on the pricing, I guess. So some of those things as we went through the week, we could have got a cap and floor, we would have had to have paid for that, for the benefit of that. So yeah, it allowed us to at least test the market and come away happy.
Good. And timing wise, obviously this was notable in that it came shortly after the conclusion of the RPI reform. Was this an important factor in determining the timing for you, and how did you find the timetable of the trade being just over a week? Was it quicker or longer than you would have expected at the outset? Yeah,
I mean, in terms of RPI reform, that was obviously very important going into it. It's obviously been a long time coming in terms of the announcement. So the NatWest team was very helpful on that, in fact, in terms of putting us in touch with your inflation experts. So both in the lead into the announcement and post the announcement, we were kind of fully updated on what was expected and what the outcome was and how that impacted the markets. So that gave us the reassurance when we were speaking with the chief financial officer and getting final approval for the trade that yes, it was correct to go ahead with it, and the markets were in a good condition for us to go forward. We had quite a tight time frame to get the transaction completed because we were looking at a small window between our interim results and basically the Christmas holiday and investors packing up for Christmas. So in terms of that, the issue was done under our EMTN program, which made things straightforward from a documentary perspective. So we just put out a supplementary prospectus, and pretty much the documents were ready to go. And in terms of the actual transaction, that went pretty quickly, really. So it was a week and a half in total. We launched on the Monday morning. We put a small statement up on the website, and then the banks went out and spoke to investors. And we had feedback through the course of the week. So as the feedback came from the investors, then we spoke to the banks and had regular meetings. And by the end of the week, we've got a pretty good idea of where the transaction was going. And we were able to update our Treasury Committee internally with kind of the broad parameters of what we were looking at. And then we finalised it very early in the following week, and were able to price on the Wednesday. So it was just about a week and a half, which was very good, really. So.
And on that pricing, how did you manage to get comfortable that you were achieving fair pricing, and how did you determine the value of CPI versus CPIH for Severn Trent Water? Yeah,
in terms of fair pricing, I guess we'd set an expectation at the start of the process. So we'd had various discussions, and we'd done the analysis to build up where we thought the pricing would be. When we'd spoken to various banks, it was actually quite a broad range, which I guess comes down to people's understanding of the market and the lack of transactions going through the market. But I guess that was one of the drivers that led us down the kind of the competitive route. And by going through the competitive route, then we were able to kind of see different pricing across different tenors. We were quite flexible on the tenors, and that allowed us to try and pinpoint where the pockets of demand were, where we could get the fairest pricing. So it was really using that competitive tension and having a nice analysis set out that we could discuss with the banks that allowed us to kind of identify where we felt the fairest pricing was. In terms of CPI versus CPIH, we had a clear steer from our Chief Financial Officer that he wanted CPIH but didn't want to overpay for that. So we just made it clear as we went through discussions what our tolerance was in terms of that we preferred CPIH, but we were only willing to pay a small amount for that. And we got prices back on both bases, and were able to kind of pick and choose then which we preferred. And CPIH we felt was valuable to us for a very small premium.
Yeah, I agree. I think it's not surprising that the opinions you get on pricing can be quite varied. I was talking about the different components that go into where does the investor interest come from, where are their views on the wedge, and the fact that it's such a liquid market with limited supply, it does lead to quite a big variation in the quotes that you do get and where CPI demand is. So overall, Nick, do you feel you achieved what you set out to on this transaction? Is there anything you do differently next time? And how has the process impacted on your ongoing management of your inflation-linked exposures?
Yeah, I mean, we were very pleased with how the transaction turned out. We got long duration debt at a very good price in the format that we wanted, with a perfect kind of hedge against our assets and revenues. We also got a new investor into our book who we hadn't had previously, so that was great news for us. We would consider kind of replicating that transaction going forward. We definitely have need for more inflation-linked debt just to maintain our sort of ratio in proportion to our growing debt. So definitely be a transaction we'd look at doing again. We'd perhaps do it, doing it again, I think we'd run the same process. We could perhaps be a bit slicker. I think some of the areas in terms of where we looked at caps and floors, we might shortcut past some of that, because I think we now have a clearer idea about what's important to us and what's important to our Treasury Committee. So we could probably expedite it a bit in that and take out some of the discussions. But yeah, it definitely worked well for us, I think.
Brilliant. Thanks, Nick. That's great to hear. Thanks very much for joining us today. It was much appreciated.